In a world changing at the speed of light, a new financial system is rising. Some are winning big, others still don't get the game. Welcome to Cryptocurrency School, where knowledge is your weapon. And crypto isn't just a buzzword, it's your future. Hey there friends, welcome back to the channel. Today I am very excited because I am gonna be sharing with you the first part of our Crypto Basics course. And this is something that I've been wanting to do for a long time, something that many of you have requested. This course will cover all the basics of cryptocurrency trading, fundamental and technical analysis. But since it's so extensive, I decided to break it down into smaller parts, and we're going to start with the most important one in my opinion, candlestick patterns. This is what I consider the best way to understand the crypto market. It's simple, it works great, and once you learn it, it becomes second nature. If you don't know me already, I am here to help you become a better crypto trader by teaching you the step-by-step process of my personal trading strategy. Over the last 2 years, I managed to grow my crypto portfolio at 10x in a bear market by doing just that. So if you're interested in learning more about my strategy, make sure to subscribe. Now before we go any further, I would like to clarify that this is not financial advice. It's only for educational purposes. Make sure to always do your own research and invest responsibly. Alright, now let's dive right in. What is a candlestick? Imagine a single candle illuminating the darkness, revealing the hidden truths of the market. That's what a candlestick is in the world of crypto trading. Just like a candle burns away, leaving behind only its wax and memories of its flame. Each candlestick reveals the highs, lows, and secrets of the market during a specific period. They appear in almost all charting libraries, and they show the change in price over time. But what exactly is a candlestick made of? Let's break it down. At the top, we have the candle wick. The wick is the thin vertical line extending above or below the body of the candle. In crypto trading, it symbolizes the reach and influence of market forces, connecting the dots of price movements. Moving down, we come to the body of the candle, the heart of the story. This is the thick part of the candle representing a specific period of time. Its color holds the key to understanding the emotions of the market, revealing whether it was a time of bullish excitement or bearish uncertainty. And finally, we have the real body of the candle. The silent witness to the market's behavior, it's the closed interval between the wicks, encapsulating the highs, lows, and closing prices of a particular moment in time. Why should you care about candlesticks? You might wonder why bother understanding these enigmatic candle patterns when you can simply trade based on gut feelings or random tips. Well, think of it this way. Candlestick patterns are like a secret code revealing the emotions and intentions of the market participants, helping you navigate the sometimes choppy waters of crypto trading. Imagine trying to predict the next move in a game of chess without looking at the pieces or the board. That's how difficult it is to understand price action without candlestick patterns. On the other hand, with this knowledge, you'll be able to spot potential trend reversals before they happen, identify key support and resistance levels, and make informed trading decisions. Candlesticks are more powerful than line charts because they provide a visual representation of price action over a specific period of time. Line charts only show the closing price, whereas candlesticks display the opening and closing prices as well as the highest and lowest prices during that period. This information is crucial for traders because it allows them to see how the price has moved throughout the day and identify trends or patterns that may emerge. For example, if the body of the candle is green, it means that the asset price increased during that period. Conversely, if the body is red, the price decreased. The size of the body also provides information about the magnitude of the price change. A large body indicates a significant price movement, while a small body suggests a relatively minor change. In addition to the color and size of the body, the shape of the candlestick can also provide valuable insights into the nature of the price movement. For example, a long thin candlestick with a thin body and long wicks on each side indicates a period of consolidation or sideways movement. This can be a sign that the market is uncertain of its next direction and is waiting for new information or events to provide clarity. Overall, Candlesticks provide a rich source of information that can help traders make more informed decisions. By understanding how to read candlestick patterns, traders can gain a deeper understanding of the market and improve their trading performance. You may have heard of terms like doji, engulfing hammer, morning star, and evening star before. All of these are candlestick patterns. We're going to cover these and much more in this series, but for now, let's focus on the basic ones. The first one is the white or bullish candle. As you probably guessed from the name, this candle indicates an uptrend. More specifically, it shows a strong bullish momentum that may lead to even higher prices in the near future. How do you recognize it? It's simple. This candlestick has a green body and long wicks on each side. Next is the red or bearish candle. This one is the exact opposite of the white candle. It signals a downtrend with a high likelihood of further price drops. It has a red body and long wicks on each side. Then we have the doji candle. This type of candlestick is a neutral pattern that signifies indecision in the market. Doji means Japanese for big head, small body. This refers to the shape of the candlestick, which has a thin body and long wicks on each side. It often appears after a strong bullish or bearish candle, signaling a potential trend reversal. Now you may notice a similarity between the doji and the previous two candles. That's because they all have long wicks. The difference lies in the color. White equals bullish, red equals bearish, black or green equals neutral. You've probably noticed that we've only covered 3 candlestick patterns so far. However, there's actually a fourth one that you need to know about, the engulfing candlestick. This pattern can be either bullish or bearish, and it's one of the most powerful candlestick patterns there is. So how do you recognize an engulfing candlestick? Here's a simple trick. Imagine the body of the previous candlestick as a circle. Now if the next candlestick has its body completely inside the circle, then we have a bearish engulfing candlestick. In contrast, if the next candlestick makes a circle around the previous one, we have a bullish engulfing candlestick. To summarize, we have 4 main candlestick patterns: white, red, doji, and engulfing. These patterns can occur randomly, but they usually appear in sequences, making it easier to predict the next move in the market. By understanding these basic candlestick patterns, you'll be able to read the market like a pro. Knowing whether the market is bullish, bearish, or uncertain will give you an edge in making profitable trades. However, please keep in mind that candlestick patterns alone are not enough to make successful trades. They should be used in conjunction with other technical analysis tools and strategies. Remember, you don't have to conquer this journey alone. If you find yourself stuck or confused along the way, don't hesitate to ask questions. You can join our community of like-minded learners and experienced traders who are always ready to lend a helping hand. Together, you can navigate the world of crypto trading and unlock its potential. So go ahead, embrace the power of knowledge, and let your crypto trading journey begin. Until next time, happy trading and good luck. Candlestick patterns that make you rich. Before we dive into patterns, let's understand the basic unit of price action, the candlestick. One candle can reveal a lot about market behavior in a specific time frame, whether it's 1 minute or 1 day. Parts of a candlestick has the body, the difference between the opening and closing price, the wick or shadow, the high and low within the time frame. Color: green for bullish, price went up; red for bearish, price went down. What it tells us: a long body means strong momentum, a short body equals indecision, long wick on top equals selling pressure, long wick on bottom equals buying pressure. Each candle reflects the emotions of the market: fear, greed, hesitation, or confidence. Learning to read a single candle accurately is the first step toward predicting the next move. Now that we're all on the same page, let's look at some simple yet powerful candlestick patterns that hold true across multiple time frames. Once you master these, I'll share advanced tactics used by the big players themselves. So stick around. If you aren't new here, welcome back. My name is Arthur. On this channel, I teach you the secrets of the Multimillionaires Investment Club so that you can make more money in the stock market. Remember, the early bird gets the worm. So if you're not already part of our community, consider joining now and don't forget to hit like. Let's jump in. Number 1. Bullish engulfing. Imagine this. You are spotting a downtrend in the market, and then suddenly there is a green candle with a huge body engulfing the previous red candle. This, my friend, is a bullish engulfing candle, and it has a signal that the market sentiment is shifting from bearish to bullish. To spot this pattern, look for a downtrend with at least 2 red candles, then wait for a green candle to appear. The green candle should have a bigger body than the last red one. When this happens, take it as an indication that the market is about to reverse upwards. But remember, this pattern alone isn't foolproof. It's best used in conjunction with other indicators and your own judgment. Number 2. Bearish engulfing. Just like its bullish counterpart, the bearish engulfing is also a reversal pattern, but it signals a shift from bullish to bearish. Look for an uptrend with at least 2 green candles and then wait for a red candle to appear. The red candle should have a bigger body than the last green one. Use this pattern in conjunction with other indicators and your own judgment for the best results. No. 3. Marubozu. Picture this. You are analyzing a chart, and you come across a perfectly symmetrical candle with thin wicks on both sides and a thick body. This is what we call a Marubozu candle. This candle often appears during times of high volatility and can be a sign of a potential breakout. It shows a strong and decisive move by the market, signaling that it's breaking out of its previous range. So when you see a Marubozu candle, especially after a period of consolidation, it might be your cue to take action. However, always consider the overall market context before making any decisions. Number 4. Doji. Now let's talk about the doji, also known as a Japanese candlestick. This pattern features a thin body and long wicks on each side. It usually appears when the market is uncertain of its next move, resulting in a sideways price action. Doji candlesticks are a signal of indecision in the market and can help identify potential support and resistance levels. They can also indicate a change in the market's momentum, often leading to a breakout after a period of consolidation. No. 5. Morning star. The morning star candlestick is a 3-candle pattern that consists of a red candle followed by a green one and ends with a small body blue candle. It signifies a potential shift from bearish to bullish sentiment in the market. The first red candle represents the previous downtrend, while the green candle indicates a reversal in momentum. The small body blue candle suggests uncertainty about the strength of the bullish move. As a trader, you can use this pattern to identify potential buying opportunities. Just keep in mind that it is not a guarantee of an instant reversal, and it is essential to use it in conjunction with other analysis tools. No. 6. Evening star. The evening star is essentially the opposite of the morning star. It is a bearish reversal candlestick pattern that appears as a green candle followed by a red one and ends with a small body red candle. This pattern suggests a potential shift from bullish to bearish sentiment in the market. Use this pattern to identify potential selling opportunities. Remember, it is not a guarantee of a sell, and it is essential to combine it with other analysis tools for better accuracy. Number 7. Hammer. Now let's discuss the hammer candlestick. This pattern has a thin body and a long lower wick. It often appears in downtrends as a sign of a potential reversal. The long wick on the bottom suggests strong buying pressure, indicating that the downtrend may be losing steam. As a trader, you can use this pattern to identify potential buying opportunities and to take profits on existing positions. Number 8. Hanging man. The hanging man is just like the hammer, but instead has a long upper wick. This pattern can signal a potential shift from an uptrend to a downtrend. The long wick on the top suggests strong selling pressure, indicating that the market may be reaching a peak and a price correction could be on the way. Use this pattern to identify potential selling opportunities or to set stop losses on existing positions. Number 9. Piercing line. The piercing line candlestick is a powerful reversal pattern with a thin body and long wicks on both sides. It's characterized by a red candle with a green wick that extends beyond the body, signaling a potential shift from bearish to bullish. This pattern often appears when the market is oversold and a sudden surge in buying activity occurs. Use this pattern to identify potential buying opportunities and keep in mind that it is more effective in conjunction with other analysis tools. Number 10. Dragonfly. The dragonfly is similar to the piercing line, except the green wick appears on the bottom of a green candle. This pattern can signal a potential shift from bullish to bearish. The green wick extending below the candle body suggests strong selling pressure, indicating that the uptrend may be losing momentum and a price correction could be on the horizon. Use this pattern to identify potential selling opportunities or to set stop losses on existing positions. And there you have it. 10 candlestick patterns that can help you make informed trading decisions. Remember, no single candlestick pattern is a guarantee of success. Instead, they offer insights into potential price movements when combined with other analysis tools. Stay tuned for more in-depth lessons on candlestick patterns and advanced trading strategies in our upcoming videos. Thanks for tuning in. Until next time, happy trading. Have you ever heard of the saying, "Eyes are the windows to the soul"? Well, I've got some news for you. It turns out that candlesticks are also the windows to the market. They reveal what the market is about to do before it actually does it. That's right. Candlesticks are like fortune tellers, but instead of predicting your future, they predict the stock market's future. So if you want to stay one step ahead of the market, keep watching, because in this video we'll be looking at the 3 most important bullish candlestick patterns that can help you to spot when the market is about to rise. These patterns are like secret codes that the market uses to communicate its intentions, and once you learn how to read them, you'll be able to see what's coming before it happens. Plus, stick around until the end of the video because we'll be sharing some tips on how to use these patterns to improve your trading. So let's dive in. 1. Bullish engulfing. Now this one is a real game changer. Imagine you're in a dark room and suddenly a bright light turns on. That's exactly what the bullish engulfing candlestick pattern looks like. But instead of light, it's prices. Now let me explain. The bullish engulfing candlestick is a 4-candle pattern that looks like this. First 2 candles are small red candles, and the last 2 candles are green. The cool thing is the second candle is completely engulfed by the third candle, which is entirely green. It's like the bulls are taking over the market and showing their dominance. You know those times when you're feeling down and then suddenly something great happens. That's what this candlestick represents. It's a signal that the bears are losing steam and the bulls are ready to charge. But wait, there's more. This pattern often appears at the bottom of a downtrend, which makes it even more exciting. It's like the bulls are making a comeback after being on the ropes. If you see this pattern, it could be a sign that it's time to buy. And if you confirm it with other indicators like RSI or volume, you'll be able to reduce false signals. Overall, the bullish engulfing candlestick is a powerful tool to have in your arsenal, as it can help you to catch a trend at its start. Just remember though, it's not the only pattern to look out for. Okay, now let's move on to the next one. Number 2. Morning Star. The morning star candlestick pattern is like a ray of hope in the early morning sky, signaling the start of a beautiful day. And who doesn't love a beautiful day? It's a 3-candle pattern that looks like this. The first candle is a long red candle, the second candle is a small indecisive candle known as a doji or small body, and the third candle is a strong green candle. Think of it as the night shift of sellers passing the baton to the day shift of the buyers. The first red candle shows the sellers are in control, but the small indecisive candle suggests they're starting to lose interest. The green candle that follows is a sign that the buyers are taking over and are eager to drive the price up. You can see this pattern at support zones, and it's a great sign that a reversal or continuation upward is coming. But don't just take my word for it. Let me show you an example. Check out this chart. You can see the price was going down, but then there was a small indecisive candle followed by a green one. Sure enough, the price started to go up. It's like magic, but it's not. It's just candlestick patterns. So keep your eyes peeled for the morning star pattern. It could be your ticket to success in the market. Number 3. Hammer. The hammer candlestick pattern is like a tool in the toolbox of a candlestick pattern. Just as a hammer has a long handle and a small head, this pattern has a small body and a long lower wick. It's a signal that the sellers tried to whack the price down, but the buyers absorbed the shock and sent the price back up. Can you feel the excitement? I get it. This pattern usually appears after a downtrend, which makes it even more interesting. It's like the bulls are tired of being beaten up and they're ready to fight back. Here's what it looks like. The first part of the pattern is a small body with a long lower wick. It's like the hammer head is taking the swing. Then the next candle will show the result of that swing. It's usually a green candle that's bigger than the previous red one. It's like the buyers are crushing the sellers. Isn't it thrilling? Just imagine the thrill of seeing this pattern unfold right before your eyes. You know that the sellers are getting desperate, but the buyers are too strong. It's like watching a boxing match in real time. But instead of punches, it's candlesticks. Anyway, when you see this pattern at a support zone, it's like finding a diamond in the rough. It's a hidden gem that can lead to big profits if you know how to use it. Now, here's a bonus tip. If you combine the hammer candlestick with other confirmation indicators like RSI or volume, you can reduce false signals and increase your chances of making a profit. It's like having a secret weapon that gives you an edge over the competition. So keep your eyes open for the hammer candlestick and be prepared to strike when the time is right. In conclusion, these 3 bullish candlestick patterns are like secret weapons that can help you to conquer the market. But remember, no one indicator or pattern is a crystal ball. It's important to use multiple sources of information and do your own research before making any investment decisions. So keep learning, keep practicing, and most importantly, keep believing in yourself. With hard work and dedication, you'll be on your way to becoming a successful trader in no time. Don't forget to share this video with your friends if you found it helpful. Until next time, happy trading! If you want to level up your trading game even further, I've got the perfect video for you. In this video, we'll show you the top 3 strategies that we personally use to generate a consistent income through trading every single month. These strategies have been back-tested and proven to work. So you know they're worth your time, plus, they're easy to understand and implement. So, you won't be left scratching your head trying to figure them out. And here's the best part. If you watch this video until the end, you'll get access to a free cheat sheet that summarizes all the key points and gives you a step-by-step guide on how to use these strategies yourself. So what are you waiting for? Click the link below to watch the video now and start taking your trading to the next level today. Don't miss out on this opportunity to learn from our years of experience and start earning a passive income through trading. Thanks for watching and good luck. The markets never cease to amaze me. One moment it's all green, everything is going up, and your portfolio looks like this. And the next moment the music stops playing, the market reverses, and your portfolio looks like this. So how do we know if the market will go up or down tomorrow? We can't, right? Well, not exactly. In today's video, I am going to share with you a method that will show you what the market will do tomorrow. How accurate is this method? In the back test I did, it was 78% accurate. That's pretty good, right? So here's the deal. If you want to access the indicator used in this video, then you have to watch the entire video. Make sure you don't skip anything because I'll be dropping some hints about how to use this method effectively. So let's begin. Section 1. Bullish Candlestick Patterns, Signs of an Uptrend. Hey there, welcome to the channel. Just like there are signs for bearish movements, there are powerful candlestick patterns that warn us of a coming drop. These are called bullish candlestick patterns, and they help you exit in time or even prepare for short trades. So let's dive into some top bullish patterns. But first, why do candlestick patterns matter? They provide a visual language to understand market psychology, helping traders spot reversals or continuations of existing trends. But remember, they're not crystal balls. Instead, they offer valuable clues. For example, imagine you're watching a stock that has been in an uptrend for days. Suddenly a bearish engulfing candlestick appears. This could signal a shift in the market's sentiment, hinting that the buyer's power might be waning and it's time to consider exiting your positions. Or if you were looking to enter a short trade, this pattern could set the stage for your plan. Now let's explore the common bullish candlestick patterns. The first one is the bullish engulfing. It's like the younger sibling to the bearish engulfing. In this pattern, a large green candle engulfs a smaller red candle. Think of it as the bulls taking charge after a brief moment of hesitation. This pattern often pops up at support levels, indicating the buyer's determination to push the prices upward. Next up is the morning star. It's a three-candle pattern that acts like an early warning system for potential bullish moves. Here's how it works. First, a strong green candle appears, signaling aggressive buying and pushing the price higher. Then a small candle follows. This one is known as a doji or spinning top. It's like the bulls taking a breather before making their final move. Finally, another green candle shows up, and this one is usually smaller than the first green candle but still holds enough power to signal a positive shift. The morning star tells us that while the bulls are in control, the sellers aren't completely out of the game yet. Last but not least, we have the shooting star. And like its name suggests, this pattern isn't always bad news. It has a small body with a long upper wick, kind of like a candle shooting up into the sky. This pattern often appears after a period of uptrend and signals that the buyers have pushed the price up, but the sellers managed to catch up just in time to prevent a bigger move before the candle closes. Now that's a close call. These patterns are like your allies on the trading field, giving you insights into the market's sentiment. But remember, they're not foolproof. Use them in combination with other analysis tools and strategies to boost your trading confidence. Keep in mind, these patterns aren't standalone strategies. They're like puzzle pieces that fit into a bigger picture when combined with other analysis techniques like support and resistance levels, Fibonacci retracements, and volume analysis. They become more precise. For instance, spotting a bullish engulfing candlestick at a support level combined with rising volume can signal a strong bullish move. Now let's see how you can spot these patterns in action. Say you're watching a stock and notice a bullish engulfing candlestick forming at a support level. At the same time, you notice a spike in buying volume. This combination suggests that the buyers are stepping in to prevent any further drops. In this case, you might choose to enter a long position, but make sure to set a stop loss below the support level just in case. Section 2. Combining candlestick patterns with support and resistance. It's like adding a secret weapon to your trading arsenal. Why support and resistance? These are price levels where the market shows a tendency to reverse. Support acts as a safety net, preventing the price from falling too far. Resistance, on the other hand, is a ceiling that the price struggles to break through. When you combine candlestick patterns with support and resistance, you get an even clearer picture of the market's intent. Let's take an example. Imagine you're tracking a stock that has a history of bouncing back whenever the price reaches a certain support level. You notice that a bullish candlestick pattern like the morning star appears at this support level. In this scenario, the pattern reinforces the likelihood of a bounce. So if you've been eyeing a long opportunity, this could be your cue to enter the trade. Similarly, if a bearish candlestick pattern like the shooting star shows up at a resistance level, it could indicate that the sellers are about to take control. If you've been considering a short trade, this might be your sign to jump in. But remember, just like with individual candlestick patterns, combining them with support and resistance levels doesn't guarantee success. Use these strategies in conjunction with other analysis tools and always keep an eye out for false signals. Section 3. Adding momentum to the mix. To add momentum to your trading strategy, you need to understand how it works. Momentum measures the rate of change in price. In simple terms, it helps you identify trends by looking at how quickly prices are moving up or down. There are various ways to calculate momentum, but the basic idea remains the same. Let's say you're interested in buying a stock. You spot a bullish candlestick pattern like the bullish engulfing combined with rising support and resistance levels. However, you want to ensure that there's enough buying power behind the move to drive prices higher. In this case, you can use a momentum indicator. If the indicator shows a positive value and is trending upwards, it suggests that buyers are pushing the price forward with increasing strength. This combination strengthens your confidence in entering a long trade. On the other hand, if you're considering a short trade, look for bearish candlestick patterns like the shooting star along with falling support and resistance levels. A momentum indicator showing a negative value and a downward trend would reinforce this bearish signal, suggesting that sellers are gaining control and the price is losing momentum. Remember, no single indicator or strategy is perfect. Use the momentum indicator as a tool to support your overall analysis, not as a standalone decision maker. Section 4. Bearish candlestick patterns warning signs of a drop. Just like there are signs for bullish movements, there are powerful candlestick patterns that warn us of a coming drop. These are called bearish candlestick patterns, and they help you exit in time or even prepare for short trades. So let's dive into some top bearish patterns. First up, we have the bearish engulfing. Imagine a small red candle being completely engulfed by a larger green candle. This is the bearish engulfing pattern. It's the opposite of the bullish engulfing, and it often appears at the top of an uptrend, signaling that the sellers are about to take charge. Next, there's the evening star. This is a three-candle pattern that serves as an early warning system for potential downturns. The first candle is typically green, indicating buyer strength. The second is a small doji or spinning top, suggesting a shift in momentum. The third candle is a large red one, showing the seller's growing influence. When you spot an evening star pattern, it's a good idea to review your positions and consider potential profit targets or stop losses. And finally, we have the shooting star, which is a bearish version of the bullish shooting star we discussed earlier. You'll recognize it by its small body and long lower wick. After an uptrend, if a shooting star appears, it's a sign that the buyers pushed the price up, but the sellers managed to catch up and bring it down before the candle closed. Remember, candlestick patterns are like puzzle pieces. They fit together with other analysis tools to form a complete picture. This is a trend. Pretty simple, right? Up, down, sideways, up, down, up. Simple, simple. But what about this? And what about this? What do these patterns mean? Are we gonna get a reversal? Are we gonna get a reversal? Are we gonna get a reversal? What do they tell us? Well, today you're gonna find out as we go over 3 continuation patterns that you can look out for to help you spot when price is gonna continue in the direction of the trend. Hello, welcome back to the channel. Before we start, if you're new here, make sure to hit subscribe. We drop a lot of educational content here every single week. So make sure to hit that subscribe button. The first continuation pattern we want to look out for is called the rising 3 methods. The way this works is you'll have an extremely bullish candle, very strong green candle with a huge body and long wicks on each side. That's gonna be your first candle. Next, you're gonna have to do 3 smaller red candles that will have low bodies, maybe long wicks, but they won't be as big as the first one. They will also stay within the range of that initial candle, meaning the low of those 2 to 3 small red candles will stay above the low of the first green candle. Lastly, you'll have a big green candle break above the high of the previous red candle. So let's take a look at an example together. Here we see an extremely bullish candle, nice green candle with a huge body, and then 2 small red candles with low bodies that stayed above the low of the first green candle. Notice how this wick is touching the candle below it, and this one is touching the candle below it. And then lastly, we have a green candle that breaks above the high of the red. This is the rising 3 methods. What does this tell us? Well, this tells us that the bulls are in control, and they're taking a quick breather before pushing the price even higher. The next continuation pattern we want to look out for is called the falling 3 methods. The way this works is you'll have an extremely bearish candle, very strong red candle with a huge body and long wicks on each side. That's gonna be your first candle. Next, you're gonna have to do 3 smaller green candles that will have low bodies, maybe long wicks, but they won't be as big as the first one. They will also stay within the range of that initial candle, meaning the high of those 2 to 3 small green candles will stay below the high of the first red candle. Lastly, you'll have a red candle break below the low of the previous green candle. So let's take a look at an example together. Here we see an extremely bearish candle, nice red candle with a huge body, and then 2 small green candles with low bodies that stayed below the high of the first red candle. Notice how this wick is touching the candle below it, and this one is touching the candle below it. And then lastly, we have a red candle that breaks below the low of the green. This is the following 3 methods. What does this tell us? Well, this tells us that the bears are in control and the bulls are trying to make a stand but ultimately will fail. Now the last continuation pattern we want to look out for isn't a candle pattern, but rather a pattern on the chart. It's called a bullish or bearish flag. First, you'll have a sharp move up or down. This is the flagpole. Next, you'll have a few candles in a tight sideways range continuing in the same direction. This is the flag. If the price breaks in the direction of the flagpole, that's continuation. Let's take a look at an example together. Here we have a sharp move up. This is our flagpole. Next, we have a few candles in a tight range continuing in the same direction. This is our flag. And then we have a sharp move up breaking the high of the previous candle. This is continuation. Same thing goes the other way around. If you have a sharp move down followed by a few candles in a tight range going downwards, then a sharp move down breaking the low of the previous candle, that's also continuation. These continuation patterns work best when used in combination with a volume indicator. Let me show you why. Here's an example where we had a rising 3 method. Price went up to small candles with low bodies and then a green candle broke above. Using a volume indicator, we can see that during the rising 3 method, volume increased. The volume is represented by the blue bars underneath the candles. When price was moving sideways during the rising 3 method, volume dropped off significantly. This is exactly what we want to see during a rising 3 method. Volume increases during the strong bullish candle because that's when buyers are entering the market and bidding up the price. Then during the 2 to 3 small red candles, volume drops off because buyers are taking profits and exiting their positions. Lastly, volume picks up again during the large green candle because buyers are entering the market once again. This is the exact volume profile we want to see during a rising 3 methods. Let's take another example. Here we have a falling 3 method. Price went down to small candles with low bodies and then a red candle broke below. Using a volume indicator, we can see that during the falling 3 method, volume increased. The volume is represented by the blue bars underneath the candles. When price was moving sideways during the falling 3 method, volume dropped off significantly. This is exactly what we want to see during a falling 3 method. Volume increases during the strong bearish candle because that's when sellers are entering the market and bidding down the price. Then during the 2 to 3 small green candles, volume drops off because sellers are taking profits and exiting their positions. Lastly, volume picks up again during the large red candle because sellers are entering the market once again. This is the exact volume profile we want to see during a falling 3 methods. Here's an example of the bullish flag. We have a sharp move up, a few candles in a tight range, and then a sharp move up breaking the high of the previous candle. Using a volume indicator, we can see that during the flagpole, volume was high. During the flag, volume dropped off significantly. This is exactly what we want to see during a flag. Lastly, volume picked up again during the continuation move. And here's an example of the bearish flag. We have a sharp move down, a few candles in a tight range, and then a sharp move down breaking the low of the previous candle. Using a volume indicator, we can see that during the flagpole, volume was high. During the flag, volume dropped off significantly. This is exactly what we want to see during a flag. Lastly, volume picked up again during the continuation move. The volume profile during the flags is what allows us to confirm whether price is gone now continue after the flag or reverse. If we only looked at these patterns without a volume indicator, we would have false signals. For example, here we have a rising 3 method. We see the candles, but if we look at the volume indicator, we see that volume didn't change much between the red candles. This tells us that although it looks like a rising 3 method, it is not really, because buyers aren't entering the market and pushing the price up during the sideways candles. Same thing goes the other way around. Here we have a falling 3 method. We see the candles, but if we look at the volume indicator, we see that volume didn't change much between the green candles. This tells us that although it looks like a falling 3 method, it is not really, because sellers aren't entering the market and pushing the price down during the sideways candles. I hope you guys enjoyed this video. If you did, make sure to hit that like button. We drop a lot of educational content here every single week. So make sure to hit that subscribe button so you don't miss out on any future uploads. Thanks for watching, and I'll see you guys next time. Hey there. Welcome back to our channel, where we try to make you a better trader by helping you understand the financial markets through economic news, trading strategies, and everything in between. And today, we're going to talk about candlesticks. Now, you may think you know about candlesticks. Maybe you've heard some of the basic ones like bullish, engulfing, or shooting stars. But have you ever thought about what these candles actually mean? What's the story behind each one? What's the psychology that drives their formation? That's what we're gonna explore today. We're going to show you how each candlestick pattern reflects the emotional state of the market, allowing you to read the chart like an open book. But here's the deal. If you want to master this skill, you need to be in the know. Our secret sauce is that we combine the power of traditional analysis with the latest AI technology. This gives us unique insights into the market sentiment. So if you're ready to take your trading to the next level, make sure you don't miss out. Before we get started, it would help if you liked this video and subscribed so you never miss any updates from us. Alright, let's dive in. First, let's discuss the bullish engulfing. Imagine this. You're in a boxing ring and two fighters are going toe-to-toe. In the last round, the bear was looking strong, pushing the price down. But now something's changed. The buyer's confidence is growing. They're throwing some powerful punches, engulfing the previous candle wick on both sides. It's a clear sign of a shift in momentum. The bullish engulfing candle represents this change in the psychological state of the market. When a bullish engulfing occurs, it's like the bulls are taking charge. The buyers are becoming more aggressive, pushing the prices up. But it's not just about the price movement. It's also about what's happening in the minds of the traders. When a bullish engulfing appears, it signals that the bears are losing interest, that their grip on the market is weakening. The buyers are starting to feel confident and in control. Here's why it's important for you to understand this psychology. By recognizing the bullish engulfing not just as a pattern, but as a signal of growing buyer confidence, you can anticipate what might happen next. When the bulls gain momentum, they don't often stop until they reach their target. A bullish engulfing is like a green flag waving in the wind, inviting you to hop on the bullish train. But remember, just like in boxing, momentum can shift quickly. Be prepared to adjust your strategy when the bears counterattack. Next, we have the hammer. Picture this. The market is on a wild ride, swinging from one extreme to another. The sellers are in the lead, pushing the prices down hard. Suddenly there's a big twist. A single red candle emerges, a lone hammer striking the chart. This is the psychological moment when panic selling meets indecision. The sellers who were driving the downward momentum start to hesitate. They're not sure if they should keep pushing or pull back. In this moment of uncertainty, the smart buyers step in. They see an opportunity to grab some good deals and start making their move. The appearance of a hammer on a chart isn't just a random occurrence. It's a reflection of the changing sentiment in the market. It shows that the sellers are getting tired, that the downward pressure is starting to ease. The hammer represents a psychological turning point where the panic subsides and rational thinking begins to take over. Here's why understanding this psychology can benefit you. The hammer isn't just a candlestick pattern. It's a signal that the market is reaching a point of equilibrium. It's a psychological wake-up call telling you to shift your focus from selling to buying. When you see a hammer on a chart, it's like a secret tip-off that the market is about to take a breather before the next big move. It's your cue to jump in and secure your position before everyone else realizes what's happening. Now let's discuss the doji. Imagine the market is at a critical point. The battle between bulls and bears is intense. Both sides are giving their all, pushing the price up and down, left and right. Suddenly the fighting stops. There's a moment of stillness, a brief pause in the action. In this moment, no one seems to be in control. Both bulls and bears are taking a breather, unsure of what the next move will be. This moment of uncertainty is reflected in the market by a tiny candle, a doji. The doji isn't just a small candle. It's a signal of confusion in the market psychology. It shows that neither the bulls nor the bears have the upper hand. The market is in a state of balance, and this balance can be your key to success. Here's why. The psychology of the market is constantly shifting. The bulls and bears are always trying to outmaneuver each other. But the doji represents a rare moment of calm in this storm. When you see a doji on a chart, it's like the market is whispering to you, telling you to hold back, to wait for the next move. It's a signal that the current trend might be nearing its end. Don't rush to make decisions. Take your time to analyze the situation. When the market is in a doji state, it's like the calm before the storm. The next move could be big, but in which direction? Only time will tell. Moving on, let's talk about the shooting star. Picture this. The market is on a rampage, driven by pure greed. The bulls are pushing the prices up, higher and higher. Everyone is caught up in the excitement, thinking this rally will never end. But then reality hits. The buyers start to feel a sense of fear. They begin to worry that they might be overextended. This sudden burst of fear brings the rally to a screeching halt. The price drops sharply, leaving a tiny candle wick at the top. This, my friends, is the psychology of a shooting star. The shooting star isn't just a candlestick pattern. It's a reflection of the changing sentiment in the market. At first, there's pure greed, an insatiable desire for more gains. But then fear kicks in, a sudden realization that things might be getting too risky. Here's the thing. The shooting star appears when the market is at a peak, when everyone thinks the party will never end. It's a psychological wake-up call, a reminder that greed and fear are two sides of the same coin. When you see a shooting star on a chart, it's like the market is flashing a warning sign. Yes, the price has been moving up, but the psychology of the market is shifting. The greed is being replaced by fear. The buyers are starting to think about taking profits and securing their gains. And when that happens, the upward momentum can grind to a halt. In the heart of the financial world, the battle between bulls and bears is as old as time. Each candlestick tells a story of this eternal struggle, revealing the emotions that drive the market. A bullish engulfing shows the confidence of buyers gaining the upper hand, while a hammer indicates a moment of panic selling met with indecision. The doji reveals a market in confusion when no one is clearly in control. And a shooting star exposes the psychology of greed and fear driving the market to unexpected halts. But here's the secret truth. While these patterns offer valuable insights, they're not the whole story. The real power lies in understanding the psychology behind them. By delving into the emotional aspect of trading, you can anticipate market shifts before they happen. So remember, the next time you look at a candlestick, don't just see a shape on the chart. See the emotions it represents, the story it's trying to tell. In doing so, you'll become a more successful trader. We hope you found this video insightful. If so, don't forget to hit that thumbs up button and subscribe for more weekly content. Thanks for tuning in, and until next time, happy trading. And this is just the beginning. If you like the vibe, hit that like button and subscribe to Cryptocurrency School. Don't forget the bell so you're first to catch the next drops. The hype is just getting started.